I'm Ben Hobbs from Johns Hopkins University, and I'm glad to welcome you to the second US-EU Future Power Markets Platform meeting, which is jointly organized by the platform and also by the Future Power Market Forum. I realize it's confusing. It sounds like the same name. It's not quite the same name, but that's a US organization that holds webinars and in-person meetings, again, on market design issues surrounding the energy transition. So our objective is to facilitate an exchange across experts and open-minded stakeholders, which I'm sure you all are, and policymakers on power market design questions. So last June, we had our first meeting, which was inspired by the standard response of many European stakeholders when they're asked about a reform towards LMP. Everybody agrees it's a great theoretical concept, but often people voice concerns that it may not be practically feasible. And so thanks to our North American partners, we had four speakers who have experience in actually implementing it. And they provided insights from many regions across North America that have successfully, at least in my view, implemented locational marginal pricing over the last quarter of a century. And they interacted with many of you in breakout sessions and in Q&A and through presentations. And you can see their presentations online if you didn't have if you weren't lucky enough to be able to join us in June. Karsten?
Mm-hmm. Well, and today we want to follow up on one of the questions that came up frequently in the conversation then, but also in European discussions. What about local price risks? It's a concern for many consumers, but also municipalities. Would local price differences keep industry away in their region if nodal pricing, locational margin pricing is implemented in a part of Europe? So for these reasons, we asked two PhD students, Leon Stolle here in our team at DIW and Jonas Böschemeier at DIW Munich, to check out what was the situation in the US and North America. And what they found, locational marginal pricing was never implemented in practice, never implemented without a mechanism that does address for consumers local price risks. So why is this the case? Well, as one implements locational marginal pricing, ISOs or whoever operates the system starts to collect congestion revenue if there's scarce transmission capacity in the system. And policymakers then had to decide who gets access to this congestion revenue, and consistently decided this should be used for consumers. We'll discuss a bit more detail, the precise allocation. And through this allocation of congestion revenues to consumers, consumers are hedged against local price risks. This was the experience we'll discuss today, how it has been done in practice, in detail across the US. Only in Europe, we keep on discussing local marginal pricing as a system that would be done, and then some congestion revenue goes away, because today congestion revenue goes away. We today give away transmission capacity for free, largely to generators, and they really like the system as it is today. But we are contemplating how to make improvements of the design, and therefore today we want to explore together how congestion revenue could actually be made accessible to the users of the system altogether. And we kick off with the summary that Leon Stolle and Jonas Böschemeier will provide from what they found out in the interviews of 15 stakeholders across North America. So the floor is yours.
Thank you, Karsten. Thank you, Ben. Jonas, can you share the slides? All right, perfect. Can you go to full screen? Wonderful. All right, perfect. Yeah, so Karsten already wonderfully introduced our project. So we were asking, okay, how are locational price risks actually hedged in North America? And for that, we interviewed 15 senior stakeholders across different ISOs. And the finding, or one of the findings, was that the main instrument to do so were financial transmission rights, congestion revenue rights, that are however, not only used to hedge locational price risk, but also have more objectives. And in this quick presentation, Jonas and I want to give you some first insights into our interviews, as well as set the base here with some terminology, so we're all on the same page in the rest of the webinar. Next page, Jonas, please. All right. So going back to the last webinar, the first ISO in North America, PJM, Pennsylvania, New Jersey, Maryland, they introduced locational marginal pricing as early as in 1998. And the most recent one to transition was the Ontario ISO, which transitioned just in May of this year. And when introducing LMP, it always came with security constrained economic dispatch, so that generators was dispatched based on least cost order, while also considering transmission constraints in the clearing. And when we then asked the different stakeholders in the interviews, okay, how were the discussions at the time of implementation, they stated that they had always been complemented by two important questions. First of all, how to distribute congestion revenue, because as Karsten already said, when there are transmission constraints and electricity flows from one node to another node, from a low price node to a high price node, then the price difference times the electricity flow is the congestion revenue collected by the ISO. And the question is, who does this belong to and how to allocate it to these people? And then secondly, the question, how to hedge locational price risk, the risk that you're at a node that is higher price and the volatility that comes with it. And we found out that as a solution, several accompanying features to locational marginal pricing were introduced. First of all, load was only exposed to zonal average prices and not to the nodal price, such that they're less exposed to nodal price fluctuations. And then the main instrument to address these two questions up here were financial transmission rights. And as I said, they address multiple objectives. I get to the next slide. And looking at the map here on the right side of the slide, the different ISOs, we see that in parentheses below the ISOs are the names of the different rights that were introduced. So they are similar in kind, though different. And we're happy to have these experts here. You can go more into the details. But for example, Anna will be speaking about congestion revenue rights in CAISO, while in other regions it's called financial transmission rights, or for example, in the New York ISO, transmission congestion contracts. And another accompanying feature that Julia will go into more detail on are so-called auction revenue rights that were introduced in some of the ISOs, which are allocated to load-serving entities who can then decide whether they want to collect the auction revenue from the FTRs or whether they want to transform the ARs into an FTR themselves. Next slide, Jonas, please. All right. A quick introduction to what actually are FTRs, financial transmission rights, or just going back to the last slide. For the sake of clarity, I will be speaking on FTRs, but then also mean congestion revenue rights. So importantly, financial transmission rights are financial products. They're not physical products, so they do not grant physical access to the transmission grid, but are settled financially. Abram will go into a bit more detail on that. And this is such that we can have an efficient dispatch, and the rights don't interfere with that. And they are then entitling the holder of the FTR to revenue from the hourly day-ahead congestion price difference between two nodes from a source to a sink pair, wherever these revenues can, in some cases of counterflow, also turn into charges instead of revenues. And we found out that the portfolio of actors, so to say, in the market are different across regions, but generally they are load-serving entities, financial participants, and electricity generators. And we then ask, okay, what are the primary objectives in your view of financial transmission rights? And here on the right-hand side, we see the answers of the, in this case, 14 interview partners. And you can see that exactly the two main questions asked during the implementation, so how to distribute congestion revenue rights and offering a congestion hedge, were the considered two main objectives of financial transmission rights. It was generally accepted that congestion revenue belongs to load because they are the ones that had originally paid for the transmission grid, so they need to be redistributed to them, and an instrument that could function as a congestion hedge. And then two more primary policy objectives were named, maintaining historical property rights, because at the time of transition, a lot of bilateral agreements were still in place and they needed to be transitioned into the new LMP system, and also creating an open and liquid market mechanism where these hedges could be traded and then also valued. And over to Jonas.
Yes, thanks a lot. Next slide, please. Right. So in addition to the objective, we also asked the experts regarding their general experience with FTR markets and whether there had been any challenges implementing them. Overall, in the interviews, it became kind of clear that the general experience was quite positive with FTRs, but there were also a couple of challenges identified in the market implementation and in the details. To that extent, FTR markets still nowadays, so we saw in PJM, it's been almost 3 decades, but even nowadays, FTR markets are still continuously assessed by the market operators and occasionally also reformed. One common issue that was mentioned by the majority of interviews is revenue inadequacy. Just quickly, it essentially describes a situation where congestion charges are not sufficient to pay out all the entitlements to FTR holders, but Anna will tell you more about this later. Two other common stated issues were credit policy, which refers to collateral rules, which essentially there's the issue that you have to strike a balance between giving market access to every market participants who demands the hedge, but also ensuring that every participant can cover their financial positions. And then thirdly, we have allocation of FTRs to the load-serving entities, which turned out to be more trickier than expected, and Julia will also tell you more about this. Generally, what we saw from the interviews is that the North American experience is not homogeneous. There are a lot of differences and between the regions, which serve as a nice learning experience for us, but also could provide guidelines for potential implementation in Europe. Another reason where those differences come from is that they are largely driven by market characteristics that are also very different across regions in North America. We stated a couple of here, but for example, we have to talk about retail competition, as there's some states like New York or Texas where you have full retail competition, but also other regions where it is non-existent. Similarly, renewable energy is very high in, for example, California and Texas, but has a very low share in other regions. And lastly, if you transition to LMP, you need to decide for yourself to what extent you want to expose load to those locational prices. As we mentioned, generally it was chosen to have zonal prices in the US, but now there's also some debates in some regions to make it obligated for large industrial consumers to directly opt in to the LMP nodal wholesale market. To conclude, the differences in experiences and the different perspectives are not just driven by different regions, they also largely depend on the stakeholder perspective. So to that extent, we are very happy to have such a diverse panel with us with different perspectives on FTR markets. And with this, I would like to give the floor to our expert panel, and thank you very much.
Okay. Thanks, Leon and Jonas. If there are any focused technical questions or clarifying questions on this presentation, be glad to take those. It's best to put those in the chat. If not, we'll go ahead with the presentations from our panelists. Okay, I don't see any questions. So, by the way, this will be a paper that will be available not only for the participants in this seminar, but hopefully published very soon And of course, there's a lot of detail in there that I think you'll find to be very interesting. So it's my pleasure to introduce Anna McKenna, who is an attorney and also vice president for market design and analysis at the California Independent System Operator. There, she leads initiatives in market infrastructure policy, performance analysis, forecasting, and regulatory affairs. And personally, I have been really lucky to have worked with her on many market design issues over the past a couple of decades in my role as chair of the CAISO Market Surveillance Committee. And I have lots of stories I could share, but Anna will be relieved that I won't share them. So Anna joined the ISO in 2005, and previous to then she practiced energy law, and she'll talk about congestion revenue rights in the California ISO from the perspective of the market operator. Her presentation will focus on allocation and auction processes and the measures that have been undertaken to address risks of congestion revenue falling short of what's necessary to cover committed payouts to rights holders, which at least to me has been a surprisingly larger issue than anticipated in the beginning. There will be an opportunity to ask Anna clarifying or focused technical questions immediately following her presentation. A broader Q&A will follow the breakout sessions. So Anna, thank you for joining us.
Thank you, Professor Hobbs, and good morning, everyone. And good afternoon and good evening, depending on which time zone you're in. Thank you for the introduction, Professor Hobbs. I will say it's been more of a pleasure for me to have worked with you over the past 2 decades and have benefited from all your guidance and input throughout these efforts that we've undertaken at the ISO. I will start with a brief introduction of who the California Independent System Operator is, in case folks are not familiar with that. We were established in 1998 as a regulated non-for-profit organization, and we manage the high voltage electric grid in California and a portion of Nevada. Our peak load was reached back in 2022. We had a very mild summer this year, so we didn't exceed that peak at 52,061 megawatt record peak. That's a significant peak on our system, but probably not the last one that we will reach. We serve over 287.2 million megawatts of hours of electricity on the grid, and we have about over 87,000 power plants capacity on the system. And we serve about 32 million people, which is not the whole state of California, but a good chunk of it. We are one of the 9 ISO RTOs in North America, and we have the largest share of balancing areas in the Western interconnection now participating in our markets. Next slide, please. I wanted to share with you all one slide ahead. Oh, there we go, that one. What our core responsibilities are. We perform different functions. As an independent system operator, we actually are also the balancing entity for our balancing area. And we also operate wholesale electric markets within that balancing area. But in addition to that, and I'll touch on that a little bit more shortly, we also now operate a Western energy imbalance market across a good chunk of the Western interconnection. That's just a real-time market at this time. And we serve as the reliability coordinator under the NERC requirements for about 25 entities in the West, and that's the majority of the Western interconnection entities. Next slide, please. The Western energy markets, we call them now the Western energy markets because we have 2 components to our Western energy markets. We have the Western energy imbalance market, which is the real-time market. We've been operating since 2014 across the Western interconnection. We are now operating with 22 participants, and that's over 11 states. And that's really limited to a real-time market only, and it allows for exchanges on a 15 and 5-minute basis across that market. We are extending the market to the day ahead, and that will start in 2026. And that day ahead market will be voluntary for those who are in the Western Energy Imbalance market, and it'll build on the success of being able to do the 15 and 5-minute dispatches to now continue doing those dispatches, continue establishing those schedules in the day ahead market with the partners that participate. We have about 7 entities that have committed to join, and 3 additional entities that are signaling their intent to join the EDAM. Next slide, please. I wanted to provide you all a little bit of a historical content here on how congestion revenue rights and congestion management has evolved in the CAISO markets that we operate. Prior to 2009, we did not have congestion revenue rights. We did not have financial rights. We had instead what we refer to as financial transmission rights, which are physical rights. There were zonal rights associated with the markets that we were operating at the time. But we did undertake a significant change to adopt our LMP markets, and that was implemented in 2009, at which time we then also implemented our financial rights, referred to as congestion revenue rights at the California ISO. In 2014, we also, as I noted earlier, adopted the Western Energy Imbalance market. I wanted to note that this market does not have financial rights. It instead allocates out congestion revenue to participating areas, and then each participating area allocates those congestion revenues out to its constituent entities. We, since 2009, have had the experience with congestion revenue rights, as Professor Hobbs noted. We have had at times some challenges around the revenue inadequacy or revenue adequacy associated with the rights that have been issued, as well as what we refer to as the auction efficiency. So in 2019, we implemented certain reforms, which I'll touch on a little bit later, and that allowed us to finer tune our instruments to better align with the revenue that is collected out of the markets. In 2023, we undertook the design of the extended day-ahead market, and FERC has now approved that. The Energy Commission Federal Energy Regulatory Commission has approved that design, and we're well on our way to implement that in 2026. But I wanted to highlight that extended day-ahead market, which extends the day-ahead market to our partners in the West, does not include financial rights for those who are joining the EDAM. We'll retain financial rights for the California ISO area, but there we are in EDAM, we've adopted a different methodology of allocating the congestion revenue, which also provides a hedge to holders of firm transmission and network rights, but it's a very different model than a financial right that we are talking about today. I wanted to note that we just also at the end of 2024 started to undertake another analysis for looking at the revenue adequacy as well as auction efficiency questions that have been raised. And I just wanted to impress upon you a very important notion that LMP markets do require continuous tuning, but the data that you get from the LMP markets is an extraordinary amount of information that is helpful in ensuring that you're providing that least cost service to load, as well as most efficient access to the grid and great competition, enhancing competition on the system, which of course leads to greater efficiencies. And so we're now in the midst of undertaking a deep dive analysis in the CRR performance again. And we have also started in 2025 an initiative to consider further changes, and I'll talk a little bit about that shortly. And I wanted to also say that earlier this year in the EDAM design, where we do not have financial rights, but we have adopted what we refer to as a congestion revenue allocation methodology, we came across some challenges in that methodology where we undertook an initiative to really fine-tune the methodology so that holders of firm transmission rights in the participating areas outside the California ISO balancing area have an opportunity to also collect sufficient revenue to cover the investments they have made through the rights that they hold. So this gives you a brief time frame. I could spend much more time on all of this, but I wanted to give you guys all the context of how these things have evolved in our markets over the years. Next slide, please. So what are congestion revenue rights, the California ISO? They are financial instruments, and they enable the holders of such rights to basically hedge against congestion risk between locations on the grid when they are now participating in the day-ahead market. And it's really isolated to the day-ahead market. There's no financial rights in the real time. And a holder of such a right will get a megawatt amount instrument. It's a source sync instrument, so it's specific to locations. And it allows the entity to then hedge against particular congestion on the system, depending on what their portfolios are. And this is important because it's not like a perfect hedge to all congestion on the system, but it does require that in the issuance of the hedge instrument, you think about how you are going to be exposed to congestion in the day-ahead market. We have two types of instruments. One is an obligation, which says that the entity who holds the instrument will be paid for that cost of congestion based on the megawatt entitlements, depending on the direction of the congestion. If the congestion is in the prevailing flow of the instrument, then they will be paid that amount. If it's count in the opposite direction, in the day-ahead market, they will pay for that amount. We also have options, and those are limited to entities that have transmission ownership rights on the system, and those don't require a payment in the opposite direction. Our instruments are basically defined by different elements. We issue monthly and seasonal CRRs, and the seasonal CRRs are really our annual CRRs, but on a monthly basis, we fine-tune the release so to ensure that entities can procure or sell CRRs to better fine-tune their portfolios. We have on-peak and off-peak time of use instruments, and we are looking, actually, and I will note that in a moment, to enhance some of those as the market has evolved with storage facilities on the system. But this is currently the definition of our instruments in the market. Next slide, please. What are the drivers behind why we have CRRs in the market? Of course, the Federal Energy Regulatory Commission, in instituting the open access principles, has advocated for allocating transmission revenues to customers that have paid for the embedded cost of the system, so that they can better hedge on the parts of the system they have invested in. And of course, the presumption there is that they'll be using that part of the system as you proceed towards an LMP market. And this hedging component, as noted earlier, is pretty much standard in most of the all of the centralized markets that have been adopted across the country. At the ISO, as we adopted these instruments, we thought it was really also very much necessary to ensure that we distribute the rents in a way that ensures better competitive participation on the system. And we not only felt it was necessary to support the instruments based on those who have paid for the embedded cost of the system, but also to ensure that participants in the market can have access to these instruments as you have third-party providers or competitive generators and marketers that need to be part of the mix of how load is served on the system. And that allows for better long-term contracting between load-serving entities and marketers and generators, and it allows for a more robust market. So these are the principles that drove our design in the early days of adopting this. Next slide, please. How can it be acquired, these instruments in the CAISO markets? There's various type of ways to obtain them. We conduct both annual and monthly allocations, as well as annual and monthly auctions. Most of the rights are allocated out to those who have paid for the embedded cost of the system, and those are load-serving entities that participate, and there could be external load-serving entities or external ones as well. If they pay for the transmission access charge, they can then get an allocation without a charge to these instruments. The way that we allocate out the instruments to the load-serving entities is based on what is a physical capacity available on the system. We don't allocate out the entire physical capacity because we do think it's important to have some additional capacity out to allow for the auction, but it does cover their prescribed entitlements that they may hold. So it's all based on designated resources and all based on load expectations for those allocations. The auction itself, on the other hand, is one where anybody can participate as long as you meet the creditworthy requirements. And in the auction process, then if you bid in to buy a point-to-point instrument, and that allows for a price discovery mechanism for the instrument, which of course is very important, and you will hear about that more. We also allow for load migration. So if a load serving an entity has load moving from one side to the other, we create a adjustment to those allocated rights so that a new entity that adopts load can always have that access to these allocated free rights. And anybody can also transact bilaterally to obtain a CRR. So if you have a holder of CRR, you can establish a contract with somebody else and have that right, and then we facilitate that transfer in the systems. I will say that we haven't seen too much of that over the years, but it is part of our design as well. Next slide, please.
And Anna, can you conclude in 2 minutes or so?
Sure.
Thank you.
I will jump to the next. If you could go to the next slide. Okay, I wanted to emphasize, and I noted earlier, that it does require continuous tuning. One of the things we look at is revenue adequacy, and revenue adequacy is simply as demonstrated from this diagram on the right, the difference between the amount of revenue collected in the market and how much you are obligated to pay out based on the instruments that have been released, both out of the CRR allocation as well as the auction. And so this is an important principle, because if you don't have enough revenue collected in a day-ahead market, then the value of that hedge it may be perceived to have been undervaluing the instrument. I'll go to the next slide, please, which is then an illustration of auction efficiency. And here is the difference between how much is paid for the CRR in the auction when it's bought out of the auction versus how much is then paid out of the market. I'm sorry, how much is paid in the auction versus how much is paid out in the market. And there could be a perception of inefficiency if what the entity is paying for the CR in the auction is significantly less than the value of the congestion that then is observed in the day-ahead market. And that is sometimes referred to as efficiency. I have a little bit of qualms with that word, but just wanted to share with you because that's a word that's been thrown around in our markets. I will jump ahead to and you have on slides 12, sorry, if I could just jump ahead to what we're looking at now to enhance some of the questions about revenue inadequacy. You can all look at the charts on your own time, and I'm happy to answer some questions, but slide 15, please. So we're looking at right now is how could you better fine tune consistency between what is released in the market, in the CRR process, and what is actually then paid for in the day-ahead market, so you can have a better alignment between what you obtain and your hedge in the day-ahead market. We've noticed that some of the issues that have been driving the revenue inadequacy are due to what we refer to as loop flows, and that is the capacity, the available transmission capacity in day-ahead market is constrained by parallel flows coming from outside of the system that then undervalues the CR that have been released. And so we're looking to and make some enhancements right now through our stakeholder initiative process to address those. We're also looking for maybe finer tuning how we measure the sensitivity of congestion between one point to another in the day-ahead market and in the CRR market to ensure that maybe some smaller flows are not accounted for that might not have significant impacts, and then make sure that the ones that do have significant impacts are accounted for. This one, the product definition alignment, is really important because as we have had more storage, solar, and wind technologies enter the system, we think there needs to be a better alignment between the product definition time of use, when are these congestion hedges actually going to be necessary for these types of resources? And we're looking to make some of those adjustments. And we're also looking at the auction efficiency to address the root causes of the difference between how much is paid for the instrument and how much is then paid out of the day-ahead market. So with that, I will conclude my presentation. Apologies for going a little bit over, but there's a lot of content and happy to answer any questions.
Thanks so much, Anna. Really helpful also to go into the details because I think they matter at the end. And nice to see how you manage to separate the operation of the system from the allocation of the revenues to have two separate debates, which we always integrate in Europe so far. Any dedicated questions on technical parts from Anna already now? In this case, I think we'll take them in the breakout groups and the panel afterwards. And I would now like to introduce Julia Frayer. Really glad that you can join us today. She's Managing Director of London Economics with long experience on economic analysis in the electricity sector across North America, South America, and also Europe. Currently looking at the shift towards locational margin pricing in Alberta as well. She'll report on her experience in various ISOs with different allocation rules of the FTRs and auction revenue rights in their context. And also, I think we'll make a cross-reference to two new reports they've been writing on MISO and PGM experience. So very much looking forward to learning from you about the experience there. The floor is yours, Julia.
Thank you, Karsten. Thank you for that introduction. I have, it seems like I have a lot of slides, but I promise I'll only be speaking to four slides, and some of it may go quicker, thanks to Leon's and Anna's presentation, so I don't want to be duplicative of it. But before I start, I wanted to set the context. In terms of my background, I am an economist by training. I wear a consultant hat on many days of the week for my clients. And so I think today what I'll speak about is really a practitioner angle. And when I say practitioner, it won't be somebody who is actually out there trading FTRs, although we have a couple of clients who we advise on because they're load-serving entities and they get entitlements, and we advise them on their strategies. But really, it's more about kind of the bigger picture perspective on what it means to have FTRs in a deregulated wholesale energy market in North America. And I will rely on two reports that we've published publicly. And so all that information is in the public domain, where a few years back we did analysis. We were requested and retained by PGM to do analysis of their FTR and AR mechanism. And a couple of years after that, requested with a slightly different assignment to also evaluate the efficacy of MISO's AR arrangements and FTR auctions. So maybe two big picture lessons I want to put out there before I start into my slides. As a practitioner looking at these markets, one of the things that, especially to somebody who is thinking about adopting nodal pricing, one of the things I sort of lay out there as a formulation that I strongly believe that FTRs are a necessary component of nodal pricing, of a decision to go to nodal pricing, which I will talk to in a little bit. But they bring a lot of complexities. I actually think at this day and age, because of all the wonderful developments from a software and market rules perspective and mathematical constructs to help us solve nodal markets quickly and effectively with all the constraints, I almost think that nodal market design is not too difficult. Perhaps folks in the room will laugh a bit at that aspect, but there are a lot of resources. I think with respect to setting up an FTR market, again, there are a lot of experiences you could look to, but the markets tend to be a lot more complex in the sense that they're very technical, much more technical than the understanding of, I would say, many stakeholders, the regulators, the policymakers, about what kind of decisions and technical details need to be made. The markets depend on the functional capacity of the tools that an ISO RTO brings to facilitating that market. That too typically appears like a black box to many outside of those directly trading in the market. And the other thing I will keep in mind is, like any market that has to do with energy, this is it's a market that deals in products that have uncertain value, and that appears and dictates a lot of observations we then see coming out of auctions, including revenue sufficiency concerns and so forth, that I'll touch upon. So if we can go, I'm going to skip a few slides because they talk about the firm and that's not necessary. If we can go to slide 5, which is really the first slide I'd like to present. And we've talked already about this in terms of what is perceived to be the purpose of having financial transmission rights of some form, of some name in a market. I think ultimately they're tied to having a nodal market, and with a nodal market, an understanding that the marginal cost of congestion, the congestion component, is likely to be much more volatile than the underlying marginal cost of energy component in the LMP. And so I think the first realization from the fact that we have a nodal market where we have now multiple pricing points, is that there's a concern that generally quite clear that legacy contracts, legacy arrangements between generators and load are now subject to a newfound risk, and a risk that has a large magnitude around it. And so that's one angle. I think the other angle also is the realization that when we do have congestion on the network, when it is, there will be, from a mathematical perspective, the payments being made to purchase energy by load serving entities will mathematically exceed the payments that generators receive. And so you're going to have this bucket of congestion rents that need to then be distributed or dealt with in some form or fashion. And so it always ties back to, I think, the concept of maybe loosely property rights, where customers who historically paid for transmission, including the development of the transmission system, should be afforded those congestion rents, the return back to load. I think purpose number one is quite logical, but I also think that if you look back at a lot of the original documents that were prepared, for example, and filed with the Federal Energy Regulatory Commission in the United States, when the initial nodal markets were born and financial transmission rights were created, purpose number one didn't feature very strongly back then. In fact, it was purpose number 2 that was the big feature. And I think it ties back with this webinar and what we're talking about, which is the idea that you need to have a working mechanism and preferably a market-based mechanism to deal with that uncertainty or a very risky congestion component in LMPs, to be able to allow market participants the ability or a pathway to hedge that if they wanted to hedge that. And so FDR auctions were meant to, markets were meant to create that. And we need to we do need to think about kind of assignment of, I will say, entitlements or rights, allocation of those rights separately from the market mechanism that then helps us ensure that those that value those rights have access to them. But having a market creates a lot of, for the FTRs, creates a lot of other interesting, I think, consequences. I do think an FTR auction, one thing we realize, happens ahead of time, ahead of the day-ahead spot market for energy. And so it is part of, I think, a parcel of markets that I call forward markets, and forward market activities, and being able to discover where we think congestion is going to be on the system in the forward market are important attributes that are really helping to think about longer term efficiencies of having market mechanisms, including the signaling of where we need investment, be that generation or transmission. So I think the price discovery aspect is quite important, and it also supports then other forward market activities, which we talked about in some of our prior reports. That's really help with liquidity of those forward markets, including forward markets of just trading basic energy, not the congestion piece, but the underlying energy piece as well. So I think our first project that I mentioned with PJM in mid-2000, when we were engaged, there was actually a debate about what is the purpose of these markets of FTRs. And I think our conclusion was that there is a dual purpose. And when we went and did the work from MISO a few years later, we saw that they actually had a dual purpose written into their mandate. So I think it's quite common, and we've heard from Anna that I think hinted to both elements or purposes as well in the discussion with respect to CAISO. So we've talked about FTRs, and I think we've talked a little bit about ARs. I want to turn our attention back to ARs and maybe do a little bit of a landscape review. If we can go to slides, I think it's 6, yes. So all U.S. markets that have nodal have some sort of FTR, although some may be called something different. And it's a financial right to the congestion. But in addition, in 3, and I'll call it 3 of the markets, despite the nomenclature, we have what I consider to be a second property right or entitlement, and that's the auction revenue rights, ARRs. We already know what that is. We've had a little bit of a preview from the initial presentation. But I think the key to remember is that ARRs are provided free of charge. So a load serving entity doesn't pay to receive that entitlement or property right. And they're typically highly linked to, for example, either historical usage of the transmission network, historical commercial arrangements on specific point-to-point paths. I think the other feature of ARs is important is that a load serving entity that gets this entitlement then has options. They can either keep this entitlement and therefore get their share of the auction revenues that emerge from the first, typically annual financial transmission rights auctions, and maybe from the follow-on monthly auctions and multi-period auctions. They also, alternatively, a holder of an AR can say, no, I don't want to get these auction revenues, my share of those. Instead, I want to convert this AR based on the specific points to be a financial transmission right. So they can take a free entitlement they get and basically bypass having to buy that same FTR and convert it into an FTR that allows them to potentially get that perfect hedge. For example, if the load serving entity gets an AR for a generator at A to its load at B, and it actually also has a bilateral contract with a generator sitting at A to its load at B, that AR, when it's transferred over or self-scheduled to become an FTR, will give them that perfect hedge. So an AR, as we learned talking to market participants, has a lot of value for load serving entities because it gives them that optionality. The issue, though, has generally been that what we've seen is most load serving entities, potentially because of their risk profile, but also potentially because of regulatory institutions and how they actually manage these instruments, typically more than 50% of the time simply go with the AR option, which gives them auction revenues, but do not convert it to an FTR. And it doesn't, one of the reasons for this is that they typically feel FTRs are a lot more risky and uncertain. They are an obligation. So an FTR that you might think has value a year in advance, that's positive, may, depending on how the network congestion actually resolves itself in the day-ahead spot market may actually be negative. And so we've observed a lot of risk aversion in holding these for regulated utilities who tend to be load-serving entities. We've also observed that this is part of the story that kind of creates some of the concerns about revenue insufficiency or inadequacy. If we step to, and I'm going a little bit out of order, so I apologize, maybe to my last slide, slide 10 for a second. And there's a small graphic that's very hard to see, but if we focus on the graphic with the two bars on the left-hand side, upper left-hand side of the slide, this has an excerpt of a chart that we had in our PJM report from 2021. So it does have a historical data series by planning years from planning year 2011-2012 through planning year 2019-2020. That's basically showing a combination of what congestion charges were actually collected by the PJM RTO and what was returned to load. And when it's returned to load, it's either returned to load through that auction revenue rights process because a load serving entity decided not to convert the ARR entitlement to an FTR, or in the case of conversion, it's returned to load in terms of day-ahead congestion earned through holding on to the FTR instrument in that case. But as we can see, there are definitely years where the blue bar far exceeds the, I'll call it golden yellow bars in 2013, 2014, 2014, 2015, and again in 2017, 2018. And this is PJM's fact pattern. But what we realized when we looked at this is it's really that imbalance, if you will, between congestion charges collected and congestion charges paid out to load serving entities. That imbalance is a function of two things. One is weather. There were major weather events that couldn't possibly be predicted with perfect accuracy, sometimes a year in advance, because those FDR auctions happen in advance of actual day-ahead spot markets. The other piece of information is, again, to what I was alluding to earlier, many load-serving entities chose to hold the ARRs instead of converting them to FTRs. So in effect, they took those auction revenues that couldn't possibly fully anticipate the impact of these weather events on congestion charges. And so there's a combination of decisions, operating strategies taken by load-serving entities in combination with uncertainty that is embedded in these markets. And when we have the auctions versus when we have the day-ahead market, that led to these years where it would have essentially been examples of revenue insufficiency. And I suspect that as we look, and we did a similar analysis, we looked at also MISO. When we did MISO's work, they had similar situations, I think. But generally speaking, we get circumstances where there's a combination of the inherent uncertainty in these markets, the timing of these markets, the timing of the auctions, the timing of the day-ahead markets, and also operating decisions, which are influenced by individual load-serving entities, their regulatory construct, the type of entitlements they get, and how well they match to their own current commercial activities. They may not have any entitlements that give them a perfect hedge at this point in time, so they just treat them as a pot of money, essentially. So all of these things have influence on the outcome of these markets. That being said, we also observed from all our work in PJM MISO that the network modeling that's done ahead of time to hand out entitlements, to figure out how much transmission capacity that may exist on the network in order to hand out the entitlements to load serving entities, and the network modeling that's done to clear the FTR auctions, the annual FTR auctions and the monthly auctions. Those network models do have to make certain assumptions. They have to make assumptions about transmission outages and so forth. So as Anna said, sometimes they may actually have to make concrete assumptions also on holding capacity for alternative uses. So those things play into it. And one of the things we've learned is that although these markets and allocation of entitlements is generally working as intended, and most stakeholders in the U.S. are comfortable with them, there's always room for improvement. And we made, yes, go ahead.
I think that's a great summary statement, if I may interrupt here.
No, that's great. And I see there's a question also. So I should pause and answer that question before we get any further.
Abram.
Julia, I'm wondering if you look at these years when the blue line is much higher than the yellow line, the polar vortex, the record winter peak. If you were an end customer, like a household in New Jersey or Pennsylvania, or one of these areas where you're served by default service, your default service customer, does this impact you at all? Does it change your bill one bit?
No, it shouldn't, because you're probably on some sort of multi-period fixed rate. There's very few customers that would have been basically seeing the wholesale price. It probably would have been larger industrial customers, but not residential and small commercial customers, because in states where there's retail competition, they would have most likely been on some sort of retail plan that might be multiple months or multiple years in length, or default service that has similar multi-period tenure. In states where you're not open to retail competition, you would have had, again, a kind of a negotiated regulatory arrangement of some sort. And there's lots of flavors of it, probably beyond this discussion, but also that type of wholesale market volatility would have been smoothed out over time.
Right. And would you think, just from your interviews with market participants who participate in the FTR auction, if you were a company that was thinking about serving default service load, do you need FTRs in order to hedge the risk of delivering power, say, into these other areas, New Jersey and that sort of stuff? And does that allow you basically to more competitively or with have a lower risk premium when you bid into those markets?
So we did notice, or observe, I shouldn't say notice, we observed based on our interviews of stakeholders that that having access to the information that emerges out of FTR auctions, and having access potentially to FTR products that are multiple years out, or at least have a tenure that starts to match the tenure of the retail products you're offering customers, was quite important. So for them as a hedging instrument, they appreciated the options that they were given, options to discover information based on the results of the auction about where there is expected congestion that they need to then plan for in their retail offerings, or potentially go out and actually hedge that congestion as well. So I think that was definitely seen as valuable. Now, not all jurisdictions have retail competition. I think what we saw in MISO does mirror that, though, because as vertically integrated regulated utilities were looking to contract for new resources, they did use information from the FTR auctions to think about what their congestion risk would be as they enter new commercial arrangements. And that was also quite valuable. They did to the extent that they didn't convert their ARs into FTRs, they did still use the funds they received from ARs to think about how that offset at least partially some of their congestion risk going forward that they would have to bear for their customers. I think I probably have used up my 10 minutes. What do you think? So I know that the slides have a lot of information in them, but I will, I think the message on this last slide is probably the key message here, that these are not perfect. There's always areas for improvement. We understand that with PJM, a lot of the recommendations we made were actually implemented since 2022 over time. I think the evolution of the products, which Anna also mentioned, is really critical. And evolution also even about how you think about entitlements and handing those out, because the AR entitlement process is not perfect either, especially when it's keyed off of a historical set of conditions or contract paths that are constantly changing. Assets are retiring, new assets are being built, new contracts are being struck between load serving entities and suppliers. So I'll end here and see if there's any questions.
Okay, thank you, Julia. We have several broad questions from Marin and Martin, others that perhaps might be, I think those are best reserved for the more general discussion, because I think any of the panelists might want to address those. I'm glancing at the list to see if there's something in particular for Julia in the way of a either clarifying or focused technical question. If there's a if I'm not seeing any of those, but if there's a participant who has one of those, perhaps you can raise your hand and you'll pop up on the screen. If not, let's go ahead to Abram's talk, and then we'll have breakouts, and then the broader Q&A. So Abram, I'm really grateful that you're joining us today, rounding out the triumvirate of experts on financial transmission rights. So as an introduction, Abram is a managing partner and co-founder of Appian Way Energy Partners, which since it began in 2014 has become a leading financial marketer focusing on congestion trading in U.S. RTO markets. Before he co-founded Appian Way, he was the head of trading for a U.S. independent power producer, Edison Mission Marketing and Trading, where he was responsible for its proprietary trading and basis risk management in U.S. competitive markets between 2001 and 2014. So, Abram, you're going to be talking about managing basis risk from the perspective of a market participant, in particular the benefits of financial versus physical transmission rights, and also going to hear about your take on liquidity in FTR markets. So thanks for joining us. Okay,
thank you. As Ben said, thank you for that introduction and those two terrific presentations beforehand. You know, I have a lot of experience trading in these markets. We also trade bilateral futures at Appian Way, and obviously a big part of my role at the IPP was in managing our basis exposure for our physical assets and also the load deals that we would serve. But actually, even before that, I was a consultant and I worked on ISO market design as the US LMP markets were being established in the late 1990s. And we can, my sense is that the public policy discussion that we had 20 and 30 years ago in the US is very similar to the discussion and issues facing Europe as you contemplate moving to LMP. So if we go to the next slide, let's take a look at a comparison of the bilateral market system like you have in Europe with the ISO system. And the key difference here is that in the bilateral system on the left, the scarce transmission capacity is rationed based on basically just who has the right to use them. Those rights can be legacy rights. They can be allocated through a competitive process, but they're often first come, first serve. They have use or lose qualities. And contrast that with the LMP system. The basic difference is that the scarce transmission capacity is rationed based on the economics. That's the key difference. It seems small, but it actually has enormous impacts on the market and on the efficiency of the market. If we go to the next slide, we can zoom in on that bilateral market and explain some of that issue. So in this, each bubble represents a different balancing authority, and each of those balancing authorities is responsible for transmission congestion management in its area, the reliability of its system. Their nightmare, the system operator nightmare there is what happened in the Iberian Peninsula. You never want that to happen. So those operators in this bilateral market need to be extremely conservative and think about worst case assumptions, especially as more and more market participants who they don't have dispatch control over end up using their system. And another really big issue that the operators have is they actually don't know. It's not like a highway that's 8 lanes and you know exactly what the transfer capability is. As you're moving power from one balancing authority to the other, it actually depends on which generators are actually running in the moment. So the operators don't know how big the pipes are, so to speak, and so they tend to use very conservative assumptions, worst case assumptions, so they won't run into a problem. And finally, there's another huge problem with this system, which is the power has this inconvenient aspect of it flows on the grid according to the laws of physics, and it doesn't follow the contract path. That is what I learned as a consultant was referred to as the contract path fiction. And so as you're moving power from one balancing authority to another balancing authority, some of that power spills over to neighboring areas, causing congestion. And even if you have a right to move that power, you might actually be curtailed because there's congestion on some other system. And you have to have the complex system for figuring out who gets access when there's transmission. So if we go to the previous slide, actually, the LMP system really solves this issue. It's basically a market system where that is consistent with the physics of the grid. So the prices support the least cost dispatch and the optimal use of transmission. And the key point is that the locational price signals that are sent are consistent with exactly the dispatch signal that the operator wants to send to the generators, so they do what the operator needs them to do in order to maintain reliability. So if we go 2 slides on, so what, next slide, please. Oh, no, this one, sorry, back one. Yeah, so what happens when we use economics instead of physical rights to allocate transmission usage? So this is an example of AEP's integration with PJM. So the blue line on the bottom is the year prior to integration, and the red line on the bottom is the next year, the first 6 months prior to integration, and then snap in October of 2025. You have AEP become a part of PJM, and you have this huge efficiency gain. So all of a sudden, you basically get 2.5 to 3 times the amount of power flows that are facilitated just because you have this efficient congestion management. So going on to the next slide, and I'll just say that this is I'll just step back for a second before I talk to the slide. The key theme here is something that Julia said earlier, which is having FTRs is absolutely a necessary component of having an LMP system. It's not ancillary. And the issue is that you actually do have this problem that was identified at the time that we were having the same public policy discussions that you in Europe are having. You know, we have nodal pricing, we could go to zonal pricing, we could do uniform pricing. And the notion is, well, geez, these nodal prices, you have different prices everywhere. That's way too complex for supporting liquidity and long-term contracting. And you know, this will have a big impact on the market. And the answer to that is that FTRs do provide that answer. And one of the challenges you have is that locational pricing doesn't really lend itself to zones, even though we really want them to, and we think that's simpler. To Julia's point, actually the nodal prices is actually more simple than the zonal prices. And you can see in this description, you have prices in PJM with congestion on the system. It's from 2001, but same congestion occurs sometimes still in PJM, and prices are different everywhere. And it's not easy to identify how you would pick out the zones. Many of the US markets actually started trying zonal pricing. New England did. PJM had to call a minimum generation emergency during the hottest day of the year because they were having units go off dispatch and send their power because they were following the incentives on their use or lose rights. And they immediately filed at FERC to go to locational pricing, and they've had locational pricing since. ERCOT also started with zonal pricing and figured out that, hey, this nodal pricing is going to be simpler and easier. And California, as Anna talked about earlier, did as well. And, one of the things, I think MISO actually, interesting market, went immediately to nodal pricing. But at the time, there was a very significant discussion and debate that, hey, you know what, let's go to something much simpler like flow gate rights. And, I think we only need like 50 flow gates was the proposal to manage the whole system. Well, I look back at the actual unique day-ahead constraints in each of the last 6 years, and it was basically about 1,500 different constraints that bound at one time or another within the MISO market. And I would say that similarly, Anna mentioned the Western energy market that is starting up, with the extended day-ahead market next year, and they are going to attempt to do that without financial rights and with matching physical rights. And I predict very rough seas ahead for them. Already the Market Surveillance Committee, Ben Hobbs' team wrote a paper that identified in a very diplomatic way some of those issues. But, I think every market that has tried to do this has had this issue. But going to the next slide, we really need these markets to do two things. We talked about maintaining efficient short-term operations and dispatch. You get much more efficient dispatch with the LMP system, but we need these markets also to have this second purpose, which is facilitating long-term contracting and efficient entry and exit. And when you do have, you can go to the next slide, when you do have this challenge of the prices being different everywhere, the nodal system really is a challenge in terms of being able to hedge at specific locations. And it's really critical. I mean, I think PJM put out a white paper when they were thinking about their FDR market. They talked about PJM having an obligation to develop and operate a market system, a market mechanism to manage congestion. And that is really critical. So if you operate the FTR system well and make this available, then generators are able to hedge. They're confident that they're able to hedge and able to get hedges. So if you switch to the next slide, and I'm just going to go through this quick. In the ISO LMP market, basically you're replacing physical rights with financial rights. So Julia talked about ARR holders. If they're actually choosing to hold their ARR dollars, that's the second bullet there, converting the ARRs to certain dollars. It's probably the case that they may not have needed those ARRs for a hedge. They're just being allocated them, but they also can, some ARR holders or load serving entities can convert the ARRs to FTRs, or they can contingently, I'll convert it to FTR if the price is low, but if the price is higher, I won't. Maybe I need a different set of FTRs that better match my business needs. Maybe I'm working with a financial intermediary. It's going to help me with all my hedges, so I'm providing the ARRs to them. A couple bullet points I didn't put there, but when you have these point-to-point ARR rights, it actually creates a a financial instrument and a product that actually has value to the load serving entity, which is why the financial integrity of that product, the revenue adequacy is so important. You can use it as collateral if you're a load serving entity. And you can use it in your risk management systems to consider the forward value of your hedges because you know you have access to these. Now, how do generators hedge? Well, it's very hard for generators to hedge unless they have open access to FTRs. So what we have found and what most of the US has found is that the more liquid FTR markets like PJM and ERCOT, you're pretty much able to get a significant chunk of the FTRs that you need to be able to hedge. And even the potential that you can get those FTRs, you can go to the next slide, it actually has a complementary relationship with the bilateral market for hedging. So we say, all right, the nodes are so simple, so complex, but you actually can have a forward market develop, and actually does develop in these markets with traded hubs and zones where you hedge at Western Hub, but you have different basis to some of the different zones near Western Hub. And in fact, there's a futures market for that, but that futures market is actually disciplined by the fact that there's a competitive FTR market where you're going in and you're able to see what those prices are. So when you get your big bank or utility comes to you and they say, I want to give you a hedge, it's like, and I'm going to go to my boss and tell him, well, what's that hedge worth? It's like, I don't know. They just took me out to a really nice steak dinner, so it's worth whatever they say it's worth. Actually, now your risk group can go to a transparent and liquid thing and say, well, wait a minute. They're saying they want to collect, $6, but in the FTR auction, it's actually worth only $3. Can we look and see if we can get a better deal from somebody else, regardless of the fact that they took you out to a steak dinner? And that disciplines the bilateral forward market such that when you have these prices, I think it's part of a contestable market, and it enhances competition and ultimately ends up reducing costs to consumers. So what you find is that the nodal spot prices drive the market expectations for the FTRs and the forward, what forward trading should occur. And those forward prices become the basis for contracting and hedging. And if it's really transparent and market participants get used to it, become more sophisticated, customers who serve the load become comfortable using FTR markets and futures markets in combination to manage their basis risk. And often it's a company like our company or a bank or somebody who is serving the load customers at the end of the day, whether it's in a retail market or in a vertically integrated market where there's that kind of thing. And I'm going to stop here because I've also probably gone over. Actually, we'll do one more slide if that's okay. I did want to respond to, so I think the right thing to do is to allocate ARRs or congestion rights to load. Load does pay for the grid, but the notion that they should be entitled to all of those rights, and if there's not a one-to-one match between exactly the profits, the blue versus the yellow graph in Julia's chart, that's a public policy problem is really flawed thinking. And when there is congestion, you can't say whether load is paying more or suppliers are being paid less. If you look at the example of California, the California IMM thinks that this is a terrible loss for ratepayers, that their FTRs being made available, that people are profiting on, who anticipated the increase in solar generation. You can see on the right side, solar has grown by year. So what happens when we add a lot of supply to the system between 2019 and 2024? Well, prices went down. Prices went down in both locations. But you know what? There's so much solar in Southern California and wind that there's a lot more congestion. And so, this story, I think, really highlights that you're basically increasing generation, you're actually getting lower spot prices for load. Suppliers are being paid less, but it really highlights the importance of access to congestion hedges for the generators that are in those locations, but also the LSEs that are contracting for remote generation and rely on the financial integrity of those products to be a hedge, and also the financial intermediaries that are transacting with them. So the system works really, really well in markets that have very liquid forward markets with extended tenors and balance of period auctions, and you can hedge these. A lot of those were the recommendations that came out of LEI's reports in PJM, and I think have also done a really good job in MISO, and I'd encourage California to hire LEI to help with market design issues going forward. And that's the end of my talk.
Thanks so much, Abram, and another very insightful presentation.